Forex trading is a complex and ever-evolving field that requires a deep understanding of the market and the various patterns that can be used to predict future trends. One of the most popular patterns used by traders is the pin bar and hammer candlestick patterns. While they may seem similar, there are some key differences that traders need to be aware of in order to make informed investment decisions. First, let's start with the basics. A pin bar is a candlestick pattern that consists of a long tail, or wick, and a small body. The tail represents the price movement that occurred during the trading period, while the body represents the opening and closing prices. A pin bar is typically used to identify a potential reversal in the market, as it shows that buyers or sellers have stepped in and pushed the price in the opposite direction. On the other hand, a hammer candlestick pattern is also a bullish pattern that indicates a reversal in trend. The hammer pattern is characterized by a long lower tail, a small body, and little to no upper tail. The long lower tail represents the rejection of lower prices by buyers, while the small body represents the opening and closing prices. So, what are the differences between these two patterns? While they may seem similar, the pin bar is actually a variation of the hammer pattern. The pin bar is simply a bullish version of the hammer pattern, while a bearish version of the pin bar is called a shooting star. The key difference between the hammer and pin bar patterns is the size and shape of the body. The body of a hammer is typically smaller than the body of a pin bar, and the pin bar often has a longer tail. In terms of practical application, both the pin bar and hammer patterns can be used to identify potential reversals in the market. Traders can use these patterns to enter or exit trades, or to set stop-loss orders to protect their investments. However, it's important to note that these patterns should not be used in isolation. Traders should always use other technical indicators and fundamental analysis to confirm their trading decisions. In addition to their practical application, the pin bar and hammer patterns can also be used to add some fun and creativity to your trading strategy. For example, some traders use the pin bar as a signal to enter a trade, while others use it as a signal to exit a trade. Similarly, some traders use the hammer pattern as a signal to enter a long position, while others use it as a signal to place a stop-loss order. Ultimately, the key to success in Forex trading is to have a deep understanding of the market and the various patterns and indicators that can be used to predict future trends. The pin bar and hammer patterns are just two of many tools that traders can use to make informed investment decisions. Don't forget to subscribe for daily tips on Forex success. Thanks for watching.